explain this to us? Because you're making the case here that we've seen some shift in the pricing of these credits that means something more fundamental.
Absolutely, yes. I mean, I think the price, I mean, we're in the middle of this violent global pandemic. You'll remember back in 2009, the time of the global financial crisis, the EU ETS market absolutely crashed because demand for carbon allowances fell as the hit to the European economy took place, and the demand for, well, emissions fell dramatically. In this case, we've had the same hit, a worse hit economically, and emissions will be down even more this year than in 2009, and yet the price remains at close to all-time highs, and crucially, on a relative basis, is trading higher than ever because it's above what we call the fuel switching level, the level where carbon prices incentivize gas-fired power stations to run ahead of coal-fired power stations. We think, therefore, the market is signaling that the so-called fuel switching paradigm, which has been the main driver of prices for the last 15 years, is coming to an end. And over this next decade, as we move towards policies geared towards hitting that net zero target by 2050 that you mentioned, we will need to go higher. We need to start decarbonizing industry, and that means higher prices.
Is there a risk here, Mark, that the market's just running ahead of the reality at this stage? I know what you're saying here, and the signalling function is clear, but as I look at maybe some of these renewable ETFs and how they've traded here, we're up 70, 80, 90% year to date. I understand that this is a really exciting theme and there's an element of gold rush around it, but is it perhaps moving ahead of the structural reality in the market?
I mean, it's a very fair question, Jeff, and I think the issue really is we're in this very low interest rate environment, and I would argue you could make the case that all markets are well above where they would be in a normal interest rate cycle. So there's a sense here in which we all have to adjust our expectations. So allowing for that, I think what the market is really pricing in is the growth prospect for renewable energy, the fact that the cost of renewable energy is falling all the time. The market is getting more familiar with it as a technology. The risk profile is becoming clearer. So you have essentially with renewable energy now a massive growth opportunity combined with very low risk, and in a risk to the project, I mean, compared with, say, oil and gas, where you're increasingly concerned about the prospects of peak demand, and therefore, you know, the risk premium for oil and gas is going up, the risk premium for renewables is going down. So if you allow for that, this very unusual time we are living through with very low, if not negative, interest rates, at least on sovereign debt, then I think these valuations can be justified.